Warren Buffett is one of our generation's greatest investors. In fact, I think he is the best investor of our time, and there's a lot I have learned from him, and I'm sure you have as well, that has shaped our portfolios in one way or another. But I think it is always beneficial to revisit or research his investing advice, as it keeps us grounded and on a path towards becoming wealthy, something we all aim for. I want to share 9 money-making rules that Warren Buffett deems essential to generate long-term wealth. So we're going to start with rule number 1 from an interview a long time ago, and you're going to hear it from him himself. So here it is.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
So there you have it. Investing in a stable company with stable and predictable financial growth. Think of it as a long-term race. Which company will most likely be at the finish line in 10 years by still being in business and bigger than they are today? The stable one, of course. That is how you win, so don't lose by choosing the unpredictable asset. Now on to Warren Buffett's rule number 2. He says, our favorite holding period is forever. So there's an older study that found the best investors were dead. So I know that sounds morbid, but the thing about those dead investors is they just leave their accounts as is and invest for the long haul. Beyond their life expectancy. Without knowing it, these dead investors are following Buffett's advice to hold stocks forever. So yes, again, I know that's morbid, but we can learn from the dead by aiming to invest in companies that we have high confidence in them being around our entire lifetime and beyond. And then doing the difficult part of buying regularly and holding. The pressure to sell and make changes is high. It's the sexy thing to do. But by holding your investment for the long term, that results in a sexy portfolio. And it's those that play the trading game and get pressured to follow the popular thing to do that will have the ugly portfolios. Plus, selling will cost you with taxes and fees. It's not worth it unless you have a legitimate reason to sell. So I think we all strive to invest in companies we feel will be around forever. I hold some of them in my portfolio, like Amazon and Microsoft, and they have been my best performers. You will see my portfolio at the end. Now, Warren Buffett rule number 3, he says, never bet against America. A rule I followed a year or two ago, and it saved me big time. So we look at Alibaba, its 5-year performance, it's down almost 57%. Now, Baba, a few years back, took a dip, and virtually the entire financial YouTube community and beyond was touting this as a must buy. They said Baba cannot be stopped and will 3x and 10x in stock price. Well, you can see since that time I circled in orange when I decided not to buy when the hype was high, it has gone down 3x, and I refuse to buy the stock for one main reason. For better or worse, the US economy is set up for innovation and growth through companies increasing their profits year over year. Other economies have governments with much more power and control over their companies, and Baba is one that we have seen random huge fines that the Chinese government has implemented, and other companies have been broken up. It goes on and on and on. But in the US, we are primed for economic growth, and our government does everything possible to make that happen. So this is a rule I listened to, went against the popular trend at the time, and it saved me from having a big loss. Not to say other economies are not successful, because there are, but this is the economy I know and have that confidence in. Plus, many of US companies operate globally, so you still get exposure to other economies in that aspect. Now on to Warren Buffett's rule number 4. He says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. In other words, why waste your time on a short-term position when you can own a long-term quality proven stock that you have high confidence in its ability to survive and succeed for another decade or more? He wrote in a shareholders letter in 1996, he says, your goal as an investor should simply be to purchase at a rational price, a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will find only a few companies that meet these standards, so when you see one that qualifies, you should buy a meaningful amount of stock. So look for those stocks that you have high confidence in its future ability to be a high returning investment in your portfolio. For me, again, Microsoft, Amazon, another one is S&P Global. There are a few examples that I hold in my portfolio, which I'll show at the end. So there you have it, his rule number 4. On to Warren Buffett's rule number 5. Be greedy when others are fearful, and fearful when others are greedy. This is probably his most famous quote. And again, my example with Alibaba. While others were being greedy with this stock, I became fearful of that because I saw the risk and it was not worth it for me. Generally, if you buy a stock that is going through a popular fad, making headlines, and people are being greedy and buying it like hotcakes, usually that is the time not to buy and stay away, as it is usually overvalued. It's way too hyped up at that time. Rather, be thoughtful, do a quantified evaluation of the business, and set a buy price that you feel is at a good valuation. Don't just buy on popularity and tips. That is a good way to ensure you lose money. I've seen it happen all too often. So really think twice and look twice before making a move. It's easy to be pressured and convince yourself to be impulsive rather than stick to your strategy. Warren Buffett rule number 6, buy wonderful businesses at fair prices. Notice he does not say cheap prices. Well, that is because wonderful businesses rarely trade at cheap prices, and if you try to wait for that cheap price to happen, it may never come. Rather, look for a fair price that you're willing to buy at in a company that will be a compounding machine for decades. Microsoft is one I have seen for years people say is too expensive, but the stock just keeps going up and up and up. In fact, over the last 5 years, it's up over 266%. And every single month of every single one of these last 5 years, others have said it's too expensive. Well, they have missed out on 266% gains. So fair prices for wonderful businesses is a solid way to buy because those quality companies will continue to what they do and grow themselves. Now, Warren Buffett's rule number 7, he says, buy only stocks you can understand. I just have grown to think this is one of the most important rules. The companies that I have lost the most money with are those I did not understand. I see people just buy into something because someone else says to do so, but they have no idea what the company does. When I started focusing on only companies I understand, that is when I started making my gains. Why? Well, if you understand the business, you know what to look for, you know the industry, the competition, on and on and on. So I hold Johnson & Johnson. But to be honest, I don't know much about the pharmaceuticals industry. I bought because of the yield and because others said to do so. It is one I stopped buying a long time ago though, and will probably sell out of someday. In fact, it's been one of my worst performing stocks. You will see my portfolio at the end and just how it's really been a dud. So understanding a stock and the company behind it already will put you at an advantage, and you will be more comfortable investing that way and lower your risks. Now, Warren Buffett rule number 8, he says, big opportunities in life have to be seized. Now, up until now, you are probably thinking, okay, old man Buffett, are all these things too careful of rules to follow? No, they are not. They are smart rules that will make you money, but Warren Buffett is also bold and makes boss moves. For example, he took a huge position years ago in Apple, a near 50% position, and it paid off big for him. Would you buy a stock that would make up 50% of your portfolio? Not many would. That was an opportunity Buffett saw and seized. So if you see an opportunity in front of you and it's in your circle of competence, take it. Now, Warren Buffett rule number 9. He says the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage, aka the moat of a company. Notice he is saying it's not the industry, but rather the company. So take AI, for example. Many will invest in any AI company as long as it is AI related because they are bullish on AI being the future. But will all AI companies survive and thrive? No. You need to consider the nuances and disparities between individual companies within the AI sector. So one reason I continue to invest in Microsoft is because I feel they have a large moat and will be one of the few AI companies that will dominate and hold key competitive advantages. Think about how they hold a monopoly in the business world with their office products like Excel and Word. Add to that their cloud offering Azure, then their early adoption and investment in OpenAI. They are and will utilize their dominant position in all these areas to grow and further make their competitive advantage more durable, ensuring disruption will be highly unlikely in their core business structure, therefore creating that long-term investment I can be confident in continuing to hold forever. So there are Warren Buffett's 9 money-making rules, and I want to provide you 2 bonus rules of my own, but first a look at my portfolio and its performance. I'm in the green over 21%, and I attribute that to following all 9 of Warren Buffett's rules that I just mentioned, plus a few more. So regarding everything he told us about buying wonderful companies we can hold forever, well, for me, It's Amazon, Microsoft, S&P Global, Vici, Realty Income, and Union Pacific. All have wide moats and all are significantly in the green for me, and I feel these companies will be around the rest of my life. Now, early on in my investing journey, I bought some losers and stocks I did not understand like AT&T, 3M, and Johnson & Johnson. Warner Bros. Discovery was a gift spun off by AT&T, but I think that one is a good turnaround play and it's a very small position in my portfolio. Regardless, eventually I want to get rid of these and replace them with forever stocks and have a truly 100% wide moat portfolio that I feel confident that it will outperform the general market. If you subscribe and follow my investing journey, you will see all my buys and sells and the impact to my portfolio as I'm transparent and share all my activity within this portfolio right here on my channel. So let me know if you have any questions. But now on to my 2 bonus rules. Rule number 1, this is simple and it is to be patient. Now this aligns with Warren Buffett in many ways, but I've always had this rule and it's been my best investing rule to follow. For example, right now I'm holding a decent amount of cash on the side and I'm being patient in not deploying it because I feel the need to. Rather, I know an opportunity will present itself and I will seize that opportunity when it happens. I have a few stocks on my watch list I have set buying prices for, so when that happens, you all will be the first to know what I buy, what I sell. But too many times have I impulsively bought a stock and it ended up being the wrong time to buy, so I've learned to stick to my strategy. Which brings me to rule number 2, create a strategy. And do not deviate from that strategy unless you feel the need to change that strategy. My strategy is following this quality checklist. I've covered it many times, but here it is quickly and simply. I buy stocks that have solid financials, a good management team, positive brand recognition, superior products and services, a wide moat, and that is at a good valuation. So I recommend creating a strategy of your own. It adds a level of accountability and responsibility to your investing. So I'm curious, after going over all these rules, what are some money-making rules you have that you would like to share that was not covered? I'd be very anxious to discuss these and us all grow our knowledge and maybe put in some extra rules into our own rule book. That would be great. So with that said, happy investing. Thank you for your support and we'll see you soon on Mark Arnold's Finance.